What if everything you heard about property investing held you back from actually investing and making a bunch of money? Hi, I'm Jaryd Krause.
And I'm Sam Powell, and we are the hosts of Property Powell's Australia podcast. And in this episode, we've gone down the myth-busting phase. There's quite a number of myths out there with property and investing, and Jaryd did a really great job in putting them together. What did we cover off on a few of these little insights, Jaryd?
Wow, we covered so many things. A lot of it is mindset stuff. Basically, that's what a myth is education around re-educating you based on wives' tales and myths around property. You know, how much money you need to start, talking about debt. Is it good? Is it bad? Interest rates, only invest with a good interest rate. We talk about cash flow is king. We talk about negative gearing. We talk about the valuations of properties, how long to hold properties. We also talk about, are you too old to start investing now? Using professionals versus not using professionals, renovations. There's so much in this pod.
Yeah, definitely a lot into it, and I hope you get a lot out of it. And this isn't obviously the end of these myths. If you have any, please leave a comment below. We'd love to keep down this path to help give you more confidence to either make that first step or continue on your journey. Also, we've got our free resource on our website. So head on over to propertypowers.au/resources. There's a really good little PDF, which wouldn't take too long to consume, but it teaches you how to obviously acquire a superior asset with a better borrowing capacity. And that's going to obviously help you achieve that superior return on investment in your journey. So I hope you get a lot out of it, and we'll see you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Another episode with my best mate, Jaryd Krause. You've got the new renovated apartment. The light's looking good. I like that plant. Just a bit of natural element to the.
Thank you. The plant's struggling, Sam. I'm leaving, right? I'm going back to Australia for 3 weeks. So I was riding around and I saw this plant. There's lots of bush around here. I just saw this small little plant in the ground. I was like, that's going to be a decoration. So I just yanked it out of the ground and put it in a jar with some water just to make a little decoration. But I think it's got maybe 1 week left, unfortunately. How are you, Sam?
I'm doing well. There's an app where you can actually you can download it. You can take a photo of your plant. It can tell you what plant it is and how to look after it. So, in case you're listening in the first time on Property Powers, we're talking about plants. It's all a troll. We're all about plants here.
We're going to talk about myths today, actually. Property investing myths that actually choke people's success in property and also can prevent them from even getting into property in the first place. Now, we've got a long list, Sam. Is there anything you want to pre-frame before we dive in, or should we just punch out this list?
Yeah, I think it's just great. There's a lot of myths and things out there, but it'd be good to just do a quick little, around the grounds. There's no sort of structure. It's just here's a myth, and we're going to riff on the thoughts, and we're going to make it short and sharp, just so you can have a little bit more sort of knowledge from where we see these myths coming through. Because I've said in the previous podcast, the world's gotten to a stage where we've gone from lack of education to over-education.
Mm-hmm.
And the risk there is that people are getting stuck in analysis paralysis. And the downside of that is the opportunity cost of you sitting on your hands doing nothing leads to that, erosion of your net wealth with inflation over time. So let's jump in. Let's have a look at these myths. See, some might be right, some might be wrong. I've got no real idea, so let's just break it down, shall we?
Yeah, and obviously, like everything, there's a spectrum, right? Everything has a spectrum. So the first one is you need a lot of money to start. Now, depending on what you believe is a lot of money is very subjective. So when somebody throws out a quote or a myth or a statement like this, how much is a lot of money? Is a lot of money $5, $10? And depends on what you're purchasing as well. So it's very subjective first. And so how much is a lot of money to you as well? But to start, I mean, some people may believe you may need 100K to start, which is not actually true. You can start with like 30 to 40 grand, right?
Yeah. That's like, from a deposit point of view, you can even go up to a 95% loan to value ratio. So just needing even like $30,000 can get you into a property that is, it's a really great starting point. And there's actually a lot of data that backs up those lower price point properties do actually perform well from a capital growth perspective. And I mean, if you look at it, I know it's probably like, say, let's look at $30,000. You're looking at that on a weekly basis. That's saving $577 a week
Over 1 year.
Over 1 year, yeah.
Yeah. So I mean, over 2 years, it's half. Over 3 years, it's a third. So
yeah. And then there's so many different ways to make money in the world. But I mean, a lot of people go around going, "Oh, I need at least 100 grand to start in property," and that's just obviously something not the case. But yeah, you hit a good point, mate. Is everyone's got their own level of what is a lot of money and what's not. But I feel that the average income in Australia sits around that $60,000 to $75,000 a year. So we're talking half your annual, obviously, gross income. That can be achieved in just a few years, and it's easy to start now than complain about how expensive it is and spend your money on shoes and, I don't know, going out, food, drinks, all those things that don't actually add to that long-term financial success.
Yeah, well, that's exactly right. Is there's got to be some serious sacrifice if you want to be successful in a certain area, and it could be time, it could be money, it could be some creature comforts and entertainment for sure. We've talked about saving for a deposit, how much you need in other episodes at the start, our first 10 primary series that we went through. So guys, go through that if you haven't. Next one is all debt is bad debt as a myth. Interesting. What do you have to say about that, Sam?
That is incorrect. There's good debt and there's bad debt in the financial world. Definition of good debt is looking at, say, an investment property in a good growth location where you can leverage into a high quality asset. That $30,000 that you put in, say it's a $300,000 property. That property, you've got the $270,000 in debt, but your 30 grand that gets you in, that is good debt because it's appreciating in value and therefore you can get returns on your investment. Bad debt is depreciating assets that we talk about, boats, jet skis, like especially cars. I think like that's probably one thing that I've seen, especially in Australia, is the access to credit. We're in a bit of a credit, cycle at this stage where people, it used to be, oh, if you want that, you need that cash to go and buy that. Now it's like, oh, you want this? Can you afford $400 a week? Then you can have this $60,000, $70,000, $80,000 car, for $400 a week. How good's that? So that's bad debt.
Yeah, and you're just kicking the can down the road, or actually making your life so much harder. That when somebody comes to you with, say, 100K of debt, so somebody comes to you with like 100K of cash with no debt versus somebody that comes to you with 100K of cash and 100K of debt, it's so much harder to get that person out of debt first, and out of bad debt anyway. Typically, I would say don't pay off, depending on how aggressive you want to grow. If you have good debt, I would typically say there's no problem, or there's no real reason to pay off that debt if your asset is staying the same and growing, and it's not depreciating too much and the inflation rate is quite high. I would, and this is obviously not financial advice, but I'm not touching my debt. I'm not paying down my good debt because of that reason. Because it gives me more access to capital. Because if I pay down my debt, then I have less cash to put into another deposit.
Yeah, and I also say don't be afraid of having debt into retirement either, because if your assets, your income is paying that interest and that debt off. Like what we talked about, a number of times is that utilizing good debt, you're actually allowing inflation to work for you as opposed to against you.
Absolutely.
Which you would have seen in the last couple of years with asset prices, going going up, and even bad assets. Like when have you heard of used cars increasing in value? That is crazy.
Yeah, I think it's maybe there's an anomaly where it's become super trendy, and how the hell are you going to predict that, right? It's maybe they don't increase in value. Maybe they just stay the same as well, or
Oh,
slightly less than others. So
you're getting into a really good topic here. Didn't see this going, but yeah, the dollar value is actually increasing. So, but what's actually happening is your net wealth, unknown to you, is being eroded away, because what the governments are actually doing is printing money, and the more money they print, it's more supply in circulation. So the purchasing power of your dollar is eroding. So you might be thinking, oh, I made my car, bought it for 20 grand, and now I'm sold it for 25 grand 2 years later. It's like, well, actually, that's the impact of what the I guess money printing cycle is actually doing. But most people don't really understand that that's how it works. So ignorance can be bliss sometimes. But
yes,
that's what we're trying to do here, right? Is to educate.
yeah, I think that's a key piece of information, Sam. Is money also depreciates. So if you can acquire something now with good debt, uh, and money's appreciating, you're securing an asset with money that's only going to get devalued. Over time, you're securing something that's a bit more high value, or something that's going to become devalued. So now the next one is renting is dead money.
Oh yeah, you're teeing me up on this one. Yes and no. So it depends on. Yeah, it always depends, right? But like,
Yeah, well, these are all yes and no question, or yes and no myths, and it all depends. But the, the they shouldn't be used as blanket statements, because
nah,
it's subjective to your personal situation.
nah. Well, put it this way: if you're renting, but you've got your money working for you in other markets that actually perform better on a capital growth perspective, that's called the rent vesting strategy. Rent money is not dead money. If you've got 100 or you've got 30 grand cash, 40 grand, whatever it is, just sitting there in cash, and you're renting, then yeah, you're paying someone else's mortgage, and the cash that you've earned and having savings is eroding away. So it's not the smartest thing to do from that perspective.
Yeah, I was renting on the Gold Coast about a year ago for a couple of years, and I did the numbers, and I was looking at either buying a investment property in a different location other than the Gold Coast with some land, versus buying the unit that I was living in, so I didn't have to pay rent. And I worked out that I would be better off financially and make more money in just 1 year, let alone the long term, compounding over time, 10 years, by just continuing to rent and seeing that as a good investment, not dead money. So it's I think you need to weigh up your opportunity cost on renting, where you're renting, how much your rent is, and do the actual calculation based on what other opportunities are out there available for you in terms of property investing.
Yeah, and I'll give you a little tip and trick: is the higher the house value you want to live in, the cheaper the rent becomes. So you can go and rent a $3 million house for $1,200 a week or $1,500 a week. If you own that $3 million house and you put, call it 600 grand into your deposit, so you've still got, 2.4 million in debt, that's costing a lot more than, $1,500 a week, essentially. So it's, and then you go into further into, will that $3 million asset grow as fast as, other more affordable price assets? Historically speaking, no. Yeah. I'll probably tangent every single myth of these, but hopefully people get out of it a fair bit of information.
Yeah, no, it's valuable for sure. Next one is only invest within a 10-kilometer radius of a CBD. I don't think I've heard this one before, Sam, but tell me why people think that's valid and why it's not.
Well, you go back in time historically, we were mainly popularised around those major CBDs in Australia and even throughout different parts of the world. So that, I guess, thought process was accurate, but with more people, and we are constantly changing, we're evolving as a species. So, that's no longer the case. The further than 10 Ks out probably used to be, what it is like going in and investing a few hours out of the CBD today. But also there's, with more information, allows you to come to different conclusions. So if you look at the landscape at the moment, where people are more able to access the internet, work online, so they have that freedom and flexibility of where they choose to live. And a lot of people are choosing to, like, obviously, I can work anywhere in Australia at the moment, and I can choose to, well, if my cost of living is too expensive in Sydney, Melbourne, Brisbane, Gold Coast, I can then choose to go and live up in another beautiful location such as Bundaberg or Cairns or Townsville, Mackay. They're like coastal locations that offer great lifestyle as well. That's a changing environment. So, yeah, I guess the myth was there's security in the CBDs, but even now, like, more and more with location research and data, you can start to pick, where they are, because they all move in different cycles. So having that thought process will, probably hamstring you a little bit just to get into those 10K radiuses or CBDs. Not everyone has the purchase price power for a house. Therefore, they're generally going into a unit from an investment perspective. But the risks with units is understanding the supply, because the first thing that is going to come through is high-rise unit apartments, which is going to suppress that unit growth. So just keep your eye on those things.
Yeah, absolutely. Now, flipping properties properties is easy money.
It depends if you. Oh no, it doesn't depend. No way. I'm fully against that. Like, you're working for it, and there's risks involved. And I've seen a lot of people, like, there's a big trend around renovating for profit, and there's definitely a science to it. But you need to be really, like, you generally have to do a couple of projects to understand how that works. Like, if you're a first time out renovator, you shouldn't be going in there with, we're going to make 50 grand, 100 grand. It's just like, break even, but learn and use that as your vehicle for, I guess, what you determine to get you to that financial freedom. But the markets can turn on you. There's not, like, the easy renovate and flip is viable, but you got to understand where that cycle is. And at this stage in the cycle, it's very challenging to make money out of renovations.
Yeah, absolutely. And even if you are to make money from a flip, like maybe you make 50 grand in 6 months and you do 2 of these a year and you're doing it full time, that's $100,000 wage. Is that really a profit? Or you're just getting a job? And is it a glorified job? Maybe not. Maybe it's a backward step in your job for your health and your body, and maybe even your mind too. So it's a pretty interesting one to try and conceptualize. Obviously, you're gonna have to run the figures and stuff like that. But if you can do it with somebody else doing it, are there even margins in it? And what's the work toll for you as well? So I would say flipping houses is definitely not easy money, in my opinion.
No, you're working for it. But what my thing that I want to tell people is, make sure you're breaking it down to the net profit, and that takes into account your agent's fees, your stamp duty, or your legal costs, your capital gains tax, all those things, your cost of materials and your time. When you start doing those figures and you're saying you're paying yourself $50 an hour, is it worth it? Or is it, you may as well just go to your cushy 9 to 5 gig and make the money, and don't take any risk, because the other risk is that if you're not ingrained into the data and the location research, you can buy an asset that actually it's at the peak of its cycle and it's got a 12-month pullback period. And if you're wanting to buy and sell within that 12-month period, you're working against yourself. Even if you have the best interior design and you've done really well in saving your money, there's still risks there to take into consideration.
Absolutely. Yeah, like you mentioned, valuations, it's a big one, which are our next few points. One massive property myth is that property values or doubles every 7 to 10 years. This is very widely spread. Now, how is that even possible? I guess this is an average, but is it true even as an average, Sam?
No. Yeah. How good's that? No. Historically, they tend to perform around a 5 to 6% per annum growth rate over a 30-year period. It's based on going back in the data. So, you can definitely get a 10-year period where they double. It just depends on where you're at in that cycle. It could be doing 10 years of absolutely nothing. If you look at Perth, the 10 years prior to probably 2009 to 2019, Perth did nothing. It was just going nowhere. Same as other parts, like even up in Gladstone in Queensland, did nothing. It went back and then it sort of recovered over a 10-year period, but it was around the same price. So that's why that market cycle timing is so important. But I guess that myth's just come about because most people would probably say that if they're buying in established locations, that you would get a decent level of growth. That's only a 7.2% growth rate year on year for 10 years. That's that rule of 72. It's definitely achievable. But if they're all averaging out to 5 to 6%, you can see that there'll be a period. It could be 10 years of doing nothing, a 10-year outperformance, and then 10 years of nothing, or it could be 10 years of really great growth, 10 years stagnating, and then an average 10 years from that. It's all different. So don't go into it thinking I can buy any property and it's going to double in 10 years.
Yeah, it's a good point. And so this also rings true with the next myth, which is properties increase in value every year. It's absolutely not true. And if you think about investing for 5 or 10 years, if you do get a good growth in the first, which is what I've noticed in my few properties, is if you get and you use a good buyer's agent to buy you the right property, the right location at the right time, based on growth metrics, you could get growth. You could get 3 years of growth, and then you might get 1 year of neutral or 1 year of slightly backwards, but you've still made a great investment, and you could sell that property then, right? So every single year is not going to be a positive year if you bring it out over a longer time span, which is okay as well, because would I be prepared to get 3 great years of growth and 1 slightly negative growth versus not investing in that property at all? Of course. So don't let that hold you back, that property increases every single year, and that if you get 1 bad year, then it's all bad and all over.
Yeah, probably it's just a different investment vehicle because it's not just an investment vehicle. It's obviously primarily a place of occupation for, I guess, households, like shelter. So it's a slow moving beast. But I mean, to say it grows every single year is not true. It depends on where it is and the asset type as well. I've valued a lot of properties in my time, and I've seen properties go back in value over a 10-year period. So just keep that in the back of your head. Yeah. And generally, not spoiler alert, they're units in, large complexes with high body corporates, or they're just not, quality investment assets, in my opinion.
Yeah, for sure. And so then speaking about values, renovating always adds value to a property as a myth. That is a massive myth. For example, we've talked about this before, where you could buy something as rundown, you could renovate it how you like to live in it, and live in it for 5 years and then try to sell it, and you put it on the market and it's not what the market wants. And well, it would be hard because 5 years, typically the property is going to value over 5 years. But let's just do it in, say, a year. You renovate it how you believe it should look like, and you put it back on the market. It may not actually add value to the property because you've renovated it in a way that you've renovated the property to become a property that the market may not actually be looking for. For example, say you have a 4-bedroom home and you turn it into a 6-bedroom home, and with more bathrooms, and you try to put the price up massively in an area where people are like, we only need a 3 to 4-bedroom home for our families close to our school. Maybe you're not going to get the value that you think that you've added. Right?
Correct. Yes, I concur, Jaryd. Well done. That was good. Yeah, it's kind of, yeah, I mean, just be smart with your renovations. Talk to your local agents. Talk to people that are in that industry to help you, justify the expense you're going to make on it. But yeah, probably one of the big ones is people that build up, so they have the low set home. Exactly what you just told me. Like, they got a 4-bedroom. They want to go and make it to a 6-bedroom, 3-bathroom. They build up. It ends up costing them hundreds of thousands of dollars. I've valued places like that where I just can't stack it up. So there's no sales to justify that higher price point. But what people are trading off is just like, well, if I were to sell this property, I'd have to pay agents' fees, stamp, and then I have to buy another property and there's stamp duty, and there's probably like at least a $50,000 transition cost. And they say, well, I'd rather take the $50,000 on the negative valuation, and not have to, be able to create my own home essentially that we want to live in. But yeah, your perception of this is going to increase its value because I put $400,000 into it doesn't necessarily lead to an increase in value because it's what the market decides, which is exactly what you said.
Massively bitter pill to swallow when you go, well, we've spent $400,000 on this renovation. We need to get that $400,000 back when we sell it. That's heavy, very, very heavy. Now, if you were to do that to build out your property portfolio, it would probably send you backwards, putting $400,000 cash into something when it could be invested somewhere else. We also talk about building out a property portfolio. The more properties you have in your portfolio, the better. Not actually true.
Is that another myth that you've just written?
That's a massive myth. The more properties, the better. And this is where you hear buyers agents or people that are teaching you how to invest in property mention that they have 10, 20, 40, 50, whatever amount of properties. Cool. But would you like to have 10 $500,000 properties, or would you like to have, half that amount, have 2 even, and for the same value,
Yeah, it always depends, right? Like, some people start off on a small cash base and they generally go to those lower priced, affordable properties in that sort of 2 to 400K band, and then they accumulate with their limited income at that time. But the majority of sophisticated investors, like, they start there and then you accumulate and then you get to a sell down period, and then you're shifting your assets into a less number because it's easier to maintain. Like, you hit a really good point, is like, if you've got 20 houses, you've got 20 kitchens, 20 hot water systems, 20 aircon units, 40 fans, 20 tenants, like, there's maintenance involved in each, and then goes to, like, as your net wealth increases, you're elevating yourself into, I guess, more savvy financial assets, such as commercial, as an example, where you do need that higher capital base to enter into it. Or you can always, there's so many different ways, like going into like trust structures and syndicates and things like that can be there. But just keep in mind that, especially the whole buyer's agent industry, is what's their prerogative. Like, they get paid for every purchase that you make, so it's in their best interest to tell you to purchase as many houses as possible at a lower price as possible. And there is some method towards that. but not for everybody. It's always case by case.
Yeah, I think a good strategy, depending on what you want in your life, is if you think about you want maybe a $5 million property valuation, you could have those 10 500K properties. But what might actually be better for you is to have $2.5 million properties, and think about the valuation of the property portfolio versus how many assets in the portfolio. And that will help you either have the diversification you want or the concentration you want. I learned from a friend of a friend that who's very wealthy that if you want to increase your wealth, you need concentration. If you want to diversify, if you want to preserve your wealth, you need diversification. So I think it's better to have concentration on a few assets and a higher property portfolio until you get to an age where you're like, I just want a lot of diversification to preserve my wealth, which could be a possibility as well. And you can actually get diversification within one big asset versus multiple small assets as well when we're looking at like a commercial shopping center or a larger commercial office building or whatnot. So yeah, it's very, very subjective, but I think it's just easier to manage smaller, less amount of properties with a higher valuation.
Yeah, you got to look at it like it's not about how many you own. Take your ego out of it. It's what's your net wealth and what's your your net income. That's pretty much what is there. People don't invest in property. Obviously to each their own. People don't invest in property because they love property. They're generally investing because they see it as a vehicle to financial freedom.
Absolutely. I think that with any asset, people don't typically always love the vehicle, but more so want the outcome. Now, speaking about money, negative gearing saves you money. So invest for tax deductions. What are your thoughts, Sam?
Yeah, look, negative gearing does save you money, but it goes down to that. Every accountant should tell you, is it best to, spend $1 to save 30 cents, or is it better to have that dollar and then spend 30 cents in tax? So, like you got to weigh it up between your personal position. It can save you money as long as that. It depends on the asset you're buying. So obviously, negative gearing is pretty common at this stage in the market where interest rates are. So you should never be investing, in my opinion, for tax purposes. Negative gearing, it's a byproduct. You should be investing for capital growth, and obviously having that income and that longer term goal of what you want that asset to do for you. That's sort of where my mind sits with it.
I'm with you. Never do something just to save, just to, for a tax, like only just for tax. Like if you're going to invest to make money. It's better to make more money than just to try and save money. I think your efforts are always better put into in making more money. Now, in terms of making more money, we now have another myth, which is cash flow is king, which is not true. Most people believe it is, but I have my thoughts on it, Sam, but I want to hear yours first.
Well, cash flow keeps you in the game. So there is an element of truth towards it. But if you are solely fixated on cash flow for investing, there's a trade-off there. And, we've talked about this a fair bit. So so do you take a slight negative cash flow with the opportunity of great capital growth? I would take that. In some circumstances, some people see that as too high of a risk, and that's fine. There's ways around that as well, but you just got to look at it to go, well, positive cash flow properties. We're talking about properties here. We're a property podcast, but would I take $1,000 positive cash flow a week, or would I take 50 grand in capital value increase? I'd take the 50K.
50K cash, you mean?
Oh, capital growth. So it's like the asset increases by an additional $50,000. I'd take that over, well, I'd rather this asset that's giving me higher cash flow, but it doesn't have the capital growth prospects that this other asset does. but that's within my risk tolerance and with my ability. Some investors don't actually have, that $200 a week or so to put towards holding the investment. But if they still have that cash availability for a deposit, well, one would say if you can save, that deposit, there's obviously some level of cash flow there that you can continue to contribute towards. But yeah, it's my kind of thing is like cash flow is not king. It's a part of the puzzle. It's a major part of the puzzle, but it's not king.
Yeah, and it's going to be situational as well, depending on where you're at in your property portfolio, and your own personal life too. So
it is like going deeper. Good question. It is king in the latter stages of your life. If you're looking for retirement and hitting there, like you should be more focused towards that cash flow because that's what's going to give you that, I guess, retirement goals. That's why people, from the in financial planning space, it's that transition to retirement schemes that are really strong, and they generally go into annuities or bonds or like really low risk assets that have no capital growth but give you that income. That's obviously what helps people get to that financial retirement space. But if you're not looking to retire in that sort of 10-year period, I'd say there's options to focus on growth because that growth can then be transferred into those cash flow assets, and you'll have, with more of an equity position, your income in the future will be greater because you've got more of a deposit to put into those types of vehicles.
Yeah, exactly. Now, the next two I kind of want to bunch together. One of the myths is new and off-the-plan properties make good investments or easy investments. And the other one is older properties. On the other end of the spectrum, older properties are always a money pit. Now, let's talk to both of these. Like an older property, it depends on the property, of course, but yeah, I'll let you speak to this, Sam. I know that you've spoken about this a lot, so your articulation may be superior.
No, come on, mate. I've been talking about this for years. I don't want to hog the mic, but love the fame. I mean, of late, you could have thrown money at anything and it's gone up in value off the plan. House and land packages, sometimes units, have done well, but we're in a really undersupplied market. Historically, though, they just don't perform as well because you're buying in an asset either it's already at its highest and best use. You're on the outskirts of town, or you've got high depreciation elements to it. So a thing to think about is the land is what increases in value. The improvements depreciate over time because they're degrading. So if you're focused on an asset that is purely all, improvements, you're fighting it. It's fighting against itself. If that makes sense.
Yeah, absolutely. Yeah. You don't want to fight against it. So we've got 3 more, but I want to just.
I'll riff on the existing older properties. Look, they generally have better land content. They're in more established locations with better infrastructure around them. You've got a strong level of owner-occupier appeal in those locations. It's a school, a shopping centres, public transport. There's so many elements to it. Yes, they have the maintenance thing. That's why people get sold on the house and land packages because it's new, it's shiny, it's got those warranties. If something breaks, yeah, sure, it might cost a few $1,000 to fix, like a hot water system, whatever. But then that is then there in place as a new hot water system for the next 10 years. So it's just a part of doing business. But what you'll see is that your capital appreciation from your investment is going to far outpace those new house and land builds. Not to say that you can't make money in those house and land and doing those builds. There's definitely strategies towards that, but that's a whole new niche. And should you be piling your whole entire investments into just house and land packages? I mean, historically, they don't perform as well. So look back, get that confidence. If you're sitting there nodding your head in disagreement, go do the research, and then let's have a bit of a chat about it. But historically it's just not in favor of strong growth because you've got so much more supply risk in that sense. So I'd take the slightly higher maintenance costs and also go into deeper into say the constructions of new dwellings and new units. There's in this cycle in the market, right? Like there's actually a lack of good quality trades in place, and you're seeing. I mean, there's a great guy, the TikTok Inspector. Check him out. Like there is horrible things going on in the building industry because people are cutting corners, and for a building company, if all goes belly up, they just declare insolvent and then they walk away and they start. It's all wrapped up in the company. You're the one that's taking the risk. You're left with everything. Is that worth it to you? It's not to me. So that's just my opinion on it.
If you speak to people that have invested in property, that are great property investors, typically you won't hear them say, I've just made so much great, like all my great best investments have been from buying off the plan or land and house packages. Typically they're older buildings with more land, higher capital growth, less supply in the area, all the things that you mentioned. So yeah, there's that one nailed, I think. Now, I want to touch on interest rates. This is a tricky one that holds people back, is that you should always go for a lower interest rate. I disagree because I have been presented with high interest rates that have helped me acquire a larger property with more borrowing capacity. That has I might pay a little bit more in the interest rate, but it's allowed me to buy a superior asset that has given me far more capital growth. And in the long run, I win versus just shopping based on interest rates.
I go a little bit further into that too and say it's the vehicle, the loan structure. So obviously the lowest interest rate is what a lot of people get drawn towards, but you might not have that redraw or that offset facility that can assist you in paying down that debt faster. So it's like more of a marketing tool for, I guess, lending institutions to get you locked in. You're getting the lower rate, but you don't have that flexibility to actually pay down debt any faster. So on the long term, you're actually paying more.
Right, exactly. Now, these last two, I want to kind of couple them together. One is that I'm too old to start investing now. And the last one is you can do it all yourself. Now, speaking to the I'm too old to start investing now, from the experience that I've had, I went away, and this is why I'm coupling these two together. I haven't done my investing all myself. I've used great buyer's agents. One Sam, for sure, the best one I bought so far. And within 1 to 2 years, we had achieved an insane result, right? If you use a professional that knows how to buy in a high growth location and a good quality asset, you can get return quite fast. And the myth might be that to get any ROI out of property, you need to hold these properties for a very long period of time, 5 to 10 plus years. Yes, to get great returns in any investment, typically the longer that you hold them, the better, right? On average. Now, that's not to say that you can get great returns in a short time frame as well, which just absolutely knocks the I'm too old to start investing myth out of the park. It's not really relevant at all. And also, you can do it all yourself. Well, you can. Should you? I think this is where people that may not have a good money mindset yet or haven't worked on their money mindset would believe, I will save more money doing it this way. Maybe you will save more money in the short term, but your goal shouldn't be to save money. Your goal should be to make more money. And the way I look at it now, and have for a few years now, is that the better the professional with good research and due diligence on them, the more money they're going to make me by paying them good money. So I'm focusing on making money, and I know that I need to hire great professionals to make me money versus me take on the workload and try to save it, which is technically really not saving because I'm doing the work. And I have to work out my effective hourly rate to see if it's actually even worth it or not. And when you compare the two, typically it's not going to be worth me doing it myself.
Yeah, well, it's that analogy is well, an analogy, but stories around: do you service your own car? Do you do your own renovations? Do you plaster? Do you do your own plumbing? Do you do your own electrical? Yes, we can all learn how to do these things. However, it's you gave me a book called The One Thing, and there's a lot of power behind that, which is just focusing on that one thing and being really, really great at that. That will enable you to leapfrog those that your competitors. But you need to be focused into that one thing. You running around doing everything, um, you just got too many distractions. So it's just understanding that value. But I mean, at the very least, I'd say hopefully we can empower you to not only take that step into going down the investment path and making your money work for you, do everything you can within your power. It will come to a stage though where you'll be like, you'll second guess yourself. Is this the right location? What's this property worth? What's that agent telling me? Is this the right investment? And that's where by doing it every single day, you get very good at it. But at the same time, it's like if you can't see the value in it, at least you're having a go. Just don't buy off the plan unit. That's all I was saying. And what was the? Oh, you're too old. I mean, obviously, there's a certain element where you can't, like, if you're 80 or something, like banks, they're going to give you that borrowing capacity. I mean, you can still buy in trust if you've got enough capital, and you can get lease stock loans and things like that where it's not actually you. So yeah, you can keep investing for your future. So don't write that off. But I'd just ask you, if you're thinking you're too old to start investing, what's your alternative?
Yeah. Wow. Let's leave on that. That's amazing. Guys, reach out. If you have any questions or help talking about not doing it all yourself, we can help you. Reach out. We'll have a chat. Book in a call. We look forward to hearing from you.